Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tonnage updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. What if the biggest mistake investors are making about XRP isn't that they're too bullish, but that they're thinking far too small? For years, the debate around XRP has revolved around price predictions. $10, $100, $1,000. Most people immediately dismiss those numbers because they compare XRP to other cryptocurrencies through the lens of retail speculation. But what if XRP isn't being positioned as a speculative asset at all? What if we're witnessing is the construction of something much larger, a new layer of financial infrastructure, a system designed not for millions of retail traders, but for banks, brokerages, asset managers, treasury funds, credit markets, and potentially trillions of dollars in institutional capital? Because while the market remains focused on charts and short-term price action, Ripple has been quietly building something very different: prime brokerage, stablecoin collateral, institutional custody, tokenized treasuries, on-chain lending, and a financial ecosystem that increasingly looks less like crypto and more like the next evolution of capital markets. And if that's true, then the market may not be valuing XRP as a cryptocurrency at all. It may be valuing it as yesterday's version of itself. And that distinction changes everything. The conversation around XRP has often been dominated by one assumption: the future price appreciation depends primarily on retail demand. The theory goes something like this: more buyers enter the market, demand increases, supply remains constrained, price rises. Simple. But this framework may completely miss what Ripple appears to be building, because historically, the largest financial assets in the world were never valued based solely on consumer participation. They were valued based on utility within the financial system itself. The global bond market wasn't created by retail investors, ladies and gentlemen. The euro-dollar market wasn't created by retail investors. The repo market was not created by retail investors. Institutional capital built them. Institutional capital scaled them. Institutional capital continued to drive them today. And that's where the XRP discussion becomes much more interesting, because Ripple's recent strategic moves suggest a focus on infrastructure rather than speculation. Write that down, ladies and gentlemen. The goal appears to be creating the rails through which institutions can move, borrow, lend, collateralize, and settle value. If that infrastructure reaches critical mass, XRP's valuation framework could change entirely, not because investors become more optimistic, but because the asset begins serving a fundamentally different function. Short-term noise, long-term structure, I always say. Price is reacting, the system's evolving. And those are not the same thing. To understand why infrastructure matters so much, we need to look back at one of the most important developments in modern financial history: the creation of the euro-dollar market during the 1950s and 1960s. At the time, dollars deposited outside the United States began accumulating in foreign banks. Initially, few people understood the significance. There was no media frenzy, no retail excitement, no speculative mania whatsoever. It was like watching paint dry on the wall. Yet those offshore dollars eventually became one of the largest financial markets on planet Earth. Why? Because institutions discovered they could use these dollars more efficiently than existing systems allowed. The infrastructure created new liquidity, new lending, new settlement mechanisms, and eventually trillions of dollars flowed through the network. The value wasn't created because people suddenly loved dollars more. The value emerged because the plumbing changed. Let this sink in, marinate on this. That's a critical distinction. Financial history repeatedly shows that when new infrastructure unlocks larger pools of capital, markets often reprice assets dramatically. Not immediately, but eventually. And that raises an important question. Could Ripple be attempting something similar within digital finance? Not recreating the euro-dollar market itself, but building institutional plumbing capable of supporting the next generation of digital capital flows. That possibility deserves serious attention. In 2025, Ripple announced one of the most significant acquisitions in its history: the acquisition of Hidden Road, valued at approximately $1.25 billion. Many observers viewed it as a straightforward business expansion, but the deeper implications may be far more important. Hidden Road wasn't just another crypto company. It operated as a prime brokerage platform, serving hundreds of institutional clients across multiple asset classes. The firm reportedly cleared trillions of dollars in annual volume. Think about what prime brokers actually do. They provide access, liquidity, execution, financing, risk management, and settlement, ladies and gentlemen. They function as operational backbone for institutional trading activity. Without prime brokerage infrastructure, ladies and gentlemen, large institutions struggle to deploy capital efficiently. With it, entire markets become accessible. This is why major players such as Goldman Sachs, Morgan Stanley, and JP Morgan built enormous businesses around prime brokerage services. These institutions understand a simple reality. Capital flows where infrastructure exists, and infrastructure attracts more capital. The acquisition effectively gives Ripple something it previously lacked: a professional front door for institutional participation. Now, this is what most people miss. The importance isn't merely that Ripple owns a prime broker. The importance is that prime brokerage creates connectivity. It connects liquidity. It connects financing. It connects collateral. It connects counterparties. And most importantly, it connects traditional finance to digital assets. That bridge may ultimately prove more valuable than any single product Ripple develops, because institutional adoption rarely happens through hype. It happens through infrastructure. One reason crypto adoption has moved slower than many expected is because institutions require far more than a simple access to an asset. They require an entire ecosystem. Consider a pension fund. Buying an asset's easy. Managing billions of dollars responsibly is much harder. Institutions need custody. They need compliance. They need financing. They need reporting. They need governance. They need insurance. They need operational control. Without these components, participation remains limited, regardless of how attractive the asset may be. This is where Ripple's broader strategy begins to reveal itself, because Hidden Road wasn't an isolated acquisition. It appears to be one piece of a larger puzzle, and each piece addresses a critical institutional requirement, one by one, layer by layer. The infrastructure stack is being assembled, and every new layer potentially increases the attractiveness of the overall system. But here's where it gets interesting. Prime brokerage alone doesn't create a financial ecosystem. You also need collateral, and that's where RWAs enters the story. Most people think of stablecoins as simple digital dollars, a convenient tool for moving money, a temporary parking space during market volatility. But within institutional finance, stablecoins can serve a much larger role: collateral. Collateral is the foundation of modern financial markets. It powers lending. It powers leverage. It powers settlement. It powers liquidity. Without collateral, financial systems become inefficient. With collateral, capital can move far more effectively. Ripple's RWAs stablecoin introduces a potentially important collateral layer into the ecosystem. Rather than simply functioning as a payment asset, RWAs can be integrated across institutional products and services. This creates the possibility for a far deeper financial architecture. Institutions can hold collateral, borrow against collateral, lend collateral, move collateral between products, and generate liquidity throughout the network. The significance of this cannot be overstated, because modern finance isn't built primarily on assets. It's built on the ability to use assets as collateral. The difference is enormous, and it may become one of the key drivers behind future digital asset adoption. Yet collateral alone is still not enough. Institutions also require something even more fundamental: trust, security, and custody. Because without custody, nothing else matters, ladies and gentlemen. Every financial revolution eventually encounters the same question: who holds the assets? It sounds simple, but throughout history, custody has often determined whether a financial innovation succeeds or fails. Institutions do not manage billions of dollars based on hope. They operate within strict risk frameworks. Every transaction must be documented. Every asset must be secured. Every movement of capital must be auditable. Without institutional-grade custody, large-scale adoption becomes almost impossible. This is one of the reasons why so many early blockchain projects struggle to attract meaningful institutional participation. The technology may have worked. The assets may have had utility, but the surrounding infrastructure was incomplete. Professional investors need something more. They need security standards comparable to traditional finance. They need governance systems. They need compliance controls. They need operational safeguards. Ripple appears to understand this reality better than most. Its acquisition of custody infrastructure through Palisade represents another critical layer in the institutional stack being built around XRP and the XRP ledger. Now, this is what most people miss. Custody is not simply about storage. Custody is about confidence. A pension fund may manage hundreds of billions of dollars. An asset manager may oversee trillions. Before those organizations can allocate capital to any ecosystem, they need assurance that assets can be secured accordingly to institutional standards. This includes multi-signature controls, segregated accounts, audit trails, governance frameworks, regulatory compliance procedures, recovery systems, risk monitoring. All of these functions are largely invisible to retail investors, but they are absolutely essential to institutional adoption. Think of custody as the foundation of a skyscraper. Nobody admires the concrete underneath the building, but without it, the structure collapses. And that's exactly why Ripple's custody strategy deserves attention, ladies and gentlemen. Write this down. Because while the market focuses on price charts, the underlying infrastructure continues expanding one layer at a time, one institution at a time, one gateway at a time. And these gateways multiply, the potential addressable market begins to grow significantly. For years, tokenization was discussed as a future possibility, a concept, a theoretical use case, a vision. Today, that vision is increasingly becoming reality. Major financial institutions are actively exploring how traditional assets can be represented on blockchain networks, treasuries, money market funds, bonds, equities, credit instruments, real estate. Virtually every financial asset could eventually become tokenized. The reason is straightforward. Tokenization offers advantages that traditional infrastructure struggles to match. Faster settlement, greater transparency, programmable ownership, fractionalization, 24-hour markets, reduced operational complexity, lower costs. But perhaps most importantly, tokenization allows financial assets to become digitally composable. Assets can interact with one another. They can serve as collateral. They can move across networks. They can integrate directly into lending and liquidity systems. This creates entirely new possibilities for capital formation, and Ripple appears to be positioning itself directly within this emerging landscape. Ladies and gentlemen, one of the most fascinating developments involves the growing intersection between tokenized treasury products and Ripple's broader ecosystem, particularly through relationships involving securitized and tokenized treasury funds. The significance extends far beyond a single fund. What matters is direction of travel. Traditional financial assets are gradually moving onto blockchain rails, and once assets become tokenized, they gain no functionality. A treasury fund is no longer just a passive investment vehicle. It becomes a digital financial instrument capable of interacting with other components of the ecosystem. This is where RWAs potentially becomes important. Imagine a future where tokenized treasury assets can interact seamlessly with stablecoins. Stablecoins interact with lending markets. Lending markets interact with liquidity providers. Liquidity providers interact with settlement systems, and settlement systems interact with bridge assets. Suddenly, what began as isolated financial products become a connected network, a digital capital market. This interconnected architecture is exactly what institutional finance requires, not isolated products, integrated systems. The market often evaluates XRP as if it exists independently, but Ripple appears to be building an ecosystem, and ecosystems are often worth far more than the sum of their individual components. To understand why infrastructure can become so valuable, consider another historical example, the development of the Federal Reserve's wire transfer system, FedWire. Today, billions of dollars move through this system every single day. But when the infrastructure was first developed, few people focused on the system itself. Most attention remained on the institutions using it, the banks, the transactions, the participants. Yet over time, it became clear that the network facilitating movement was incredibly valuable, not because it owned the money, but because it enabled the money to move efficiently. That distinction matters. Financial infrastructure often becomes more important than the individual assets moving through it. The rail can become as valuable as the train, sometimes even more valuable. And this is where many XRP discussions become overly simplistic. Their focus remains entirely on the asset, while potentially overlooking the infrastructure being constructed around the asset. If XRP increasingly functions as a bridge between liquidity pools, collateral systems, tokenized assets, and institutional settlement networks, then its valuation framework may eventually evolve. Again, this does not guarantee any specific price target, but it does not change the conversation because the question shifts from how many people will buy XRP to how much value could flow through systems connected to XRP. Those are very different questions, and they can produce very different outcomes. Think about the Roman road network, ladies and gentlemen, not the empire itself. The roads. The roads connected provinces. They connected trade routes. They connected resources. They connected military logistics. Commerce expanded because movement became easier. The roads did not create the goods. The roads enabled the goods to move. Modern financial infrastructure works in much the same way. Liquidity seeks efficient pathways. Capital seeks efficient pathways. Settlement seeks efficient pathways. The easier value can move, the larger the network can become. This analogy helps explain why infrastructure investments often generate outsized returns, not because they directly create demand, but because they reduce friction. And reduced friction attracts activity. Activity attracts capital. Capital attracts more participants. The cycle becomes self-reinforcing. Ripple's strategy increasingly resembles an attempt to reduce friction across multiple layers simultaneously. Settlement, collateral, custody, lending, tokenization, prime brokerage. Each component strengthens the others, and that is the interconnected structure may ultimately prove more important than any individual product. The liquidity flywheel begins to form. Financial systems thrive on liquidity. Without liquidity, markets become inefficient, spreads widen, costs increase, participation declines. With liquidity, the opposite occurs. Markets deepen, capital moves faster, risks decline, participation expands. The interesting aspect of Ripple's current strategy is that multiple liquidity mechanisms appear to be developing at the same time. Prime brokerage increases institutional access. RLUSD increases collateral functionality. Custody increases confidence. Tokenization increases asset availability. And each improvement potentially reinforces the others. This creates what many analysts describe as a liquidity flywheel. As liquidity improves, participation grows. The process becomes cumulative, not overnight, but progressively. And eventually, systems can reach critical mass. This is exactly why infrastructure matters so much, because once a network reaches sufficient scale, growth can accelerate. Not because sentiment changes, but because utility expands. Short-term noise, long-term structure. Prices react and systems evolving. And again, those are not the same thing. Ladies and gentlemen, every major financial system eventually revolves around one thing: credit. Not payments, transfers, not speculation, credit. The ability to borrow, the ability to lend, the ability to transform assets into productive capital. And this is where the next phase of Ripple's vision becomes particularly important, because the XRP ledger is evolving beyond payments, beyond settlement, beyond transfers, into something potentially much larger, an on-chain credit market. And if the development succeeds, it may fundamentally change how investors value XRP itself, because assets become exponentially more useful when they can actively participate in credit creation. And that's exactly where the XLS66 lending protocol enters the story. The XLS66 development that could change everything, ladies and gentlemen. Every mature financial system eventually develops around a simple principle. Assets do not sit idle. They work. Government bonds become collateral. Treasuries become financing instruments. Equity support lending markets. Real estate supports mortgages. The modern financial system is built on the productive use of assets. Historically, one of crypto's limitations has been that many digital assets primarily functioned as speculative stores of value. People bought them, held them, waited for appreciation, and little else. But institutional finance demands far more functionality. Institutions do not simply want to own assets. They want to deploy assets. They want to borrow against them, lend them, generate yield from them, manage liquidity through them, and integrate them into larger capital structures. This is why the development of XLS66 on the XRP ledger has attracted growing attention. The proposed lending framework introduces native lending functionality directly onto the network. In practical terms, this means assets within the ecosystem could potentially become active participants in credit markets rather than remaining static. Assets could support borrowing and lending through structured mechanisms such as single asset vaults and fixed-term lending agreements. Now, this is what most people miss. Credit markets are not a side feature of modern finance. They are the core feature. Global financial systems are built on credit creation. Banks create credit. Bond markets create credit. Repo markets create credit. Commercial paper creates credit. Credit fuels investment. Investment fuels growth. Growth fuels economic activity. This ability to create, manage, and distribute credit is one of the defining characteristics of mature financial systems. And if XRP increasingly becomes integrated into those processes, then investors may eventually need to reevaluate the asset through a very different lens, not merely as a payment token, not merely as a speculative asset, but as infrastructure supporting broader financial activity. That distinction matters because infrastructure assets are often valued differently than transactional assets. Imagine standing in a medieval trading city. Merchants arrive carrying gold, silver, spices, textiles, and agricultural goods. Initially, trade requires direct exchange. Barter dominates. Transactions remain slow and inefficient. Then banking networks emerge. Credit instruments appear. Letters of credit develop. Settlement becomes easier. Commerce expands dramatically. The wealth explosion that followed was not created solely by more goods. It was created by better financial infrastructure. The underlying products remained important, but the systems enabling exchange became transformative. Modern blockchain infrastructure could be experiencing similar evolution. The first phase focused on asset creation. The next phase increasingly focuses on financial functionality. Liquidity, collateral, credit, settlement, custody, tokenization. These are the building blocks of advanced financial systems, and Ripple appears to be positioning itself on multiple layers simultaneously. Again, this does not guarantee success, it does not guarantee adoption, and it certainly does not guarantee any specific valuation outcome. But it does suggest that the surrounding XRP conversation may be evolving. So what exactly do supporters mean when they discuss institutional repricing? The concept is actually quite straightforward. Markets frequently misprice assets during positions of structural transition. Investors often value assets based on current utility rather than future utility. They focus on existing demand rather than emerging demand. They focus on today's infrastructure rather than tomorrow's infrastructure. This occurs repeatedly throughout financial history. Entire industries can remain undervalued while critical. Infrastructure is being built, then suddenly as adoption reaches a critical threshold, valuation adjusts. Not because investors become irrational, but because assumptions changed. The institutional repricing argument suggests XRP could potentially experience a similar transition if multiple infrastructure layers become operational simultaneously. Prime brokerage, institutional custody, stablecoin collateral, tokenized assets, credit markets, settlement systems, potential ETF access. If enough of these components achieve meaningful adoption, XRP's role within the financial ecosystem could become significantly larger than many current valuation models assume. Notice the important distinction. The thesis is not that XRP reaches higher valuation because retail investors become excited. The thesis is that institutional utility expands. That utility drives demand. That demand influences valuation. Whether that ultimately occurs remains uncertain. But the mechanisms itself differ substantially from traditional crypto speculative narratives. Another potential catalyst frequently discussed by market participants involves exchange-traded funds. Again, not because ETFs magically create value, but because they create access. Access matters. Institutional capital often operates through specific investment structures. Many institutions cannot directly purchase digital assets. They require regulated investment vehicles. They require custodians. They require compliance frameworks. They require approved allocation channels. ETFs can potentially provide those channels. The significance of ETFs is therefore not simply inflows. The significance is expanded accessibly. And when accessibility combines with custodial collateral systems tokenization, lending and settlement infrastructure, the overall ecosystem becomes more attractive to institutional participants. One catalyst alone rarely transforms a market. Multiple catalysts working together can. This is why many XRP supporters focus on the stacking event. Not one development, many developments. Not one doorway, many doorways. Not one source of liquidity, multiple sources of liquidity. And when viewed collectively, the broader strategy becomes easier to understand. Now we arrive at the question, the $1,000 question. Everyone wants answer. Can XRP reach $1,000? The honest answer is simple. Nobody knows. Anyone claiming certainty is making assumptions about future adoption, regulation, competition, market structure, institutional behavior, and economic conditions that simply cannot be known today. However, what can be analyzed is the framework behind the argument. Supporters of the $1,000 thesis generally believe that if XRP becomes deeply embedded within institutional financial infrastructures, traditional valuation metrics may no longer apply. Critics argue that market capitalization constraints liquidity realities, competitive pressures, and opposition and adoption challenges make such targets unlikely. Both perspectives deserve consideration. What matters most is understanding the difference between speculation and infrastructure. The stronger the infrastructure becomes, the more credible the institutional thesis becomes. The weaker adoption remains, the weaker the thesis becomes. Ultimately, real-world utility will determine the outcome, not social media, not influencers, not headlines, not hype, not utility, liquidity, adoption, usage. Those are the variables that matter. Everything else is secondary. Whether XRP ultimately reaches $10, $100, $1,000, or something entirely different may not be the most important question. The biggest story is the transformation occurring beneath the surface. Traditional finance is changing. Tokenization is advancing. Stablecoins are expanding. Institutional blockchain adoption is increasing. Digital asset infrastructure is maturing. And the boundaries between the traditional finance and blockchain finance continue to blur. This evolving is occurring. This evolution is occurring regardless of daily market volatility, regardless of headlines, regardless of sentiment. The infrastructure race is underway. Major institutions are positioning themselves. Governments are studying the technology. Asset managers are experimenting with tokenization. Financial markets are becoming increasingly digital. The real question is not whether change is happening. The real question is which networks, assets, and institutions ultimately capture the greatest share of the change. Ripple clearly intends to be one of them. Whether it succeeds remains to be seen, but its strategy has become increasingly difficult to ignore. For years, XRP has largely been discussed through the lens of speculation, price predictions, market cycles, retail enthusiasm, but a different narrative may now be emerging. An infrastructure narrative, a narrative built around custody, collateral, prime brokerage, tokenization, credit markets, institutional access, and financial integration. If these systems achieve meaningful adoption, XRP could eventually be viewed very differently than it is today. Not merely as a cryptocurrency, but as a component within a larger financial architecture that does not guarantee extraordinary price appreciation. It does not eliminate risk, and it does not ensure success, but it does create a framework that extends far beyond traditional crypto. Because while many investors focus on price, institutions focus on infrastructure. And throughout history, infrastructure has often been the largest opportunity emerge. Short-term noise, long-term structure. Prices reacting, systems evolving. And that may be the most important story of them all. If you enjoyed this analysis, be sure to subscribe, join the Wolfpack, leave a comment with your thoughts on XRP Institutional Future, and let me know which assets you would like us to examine next. Because the biggest changes in financial history are rarely obvious while they're happening, but they become impossible to ignore once they're complete. We'll see you in the next video. As always, do your own research. Never invest based solely on YouTube. And remember, short-term noise, long-term structure. I'll see you in the next one. This content is for informational and entertainment purposes only. Should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd reacting after the move, rationalizing why they missed it, telling themselves it'll never happen again, or you could be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise, while XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story, just the beginning. This opens your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. I'll see you tomorrow at 7.